Hey, this is Goff, and in this training video, you'll discover that there are 4 ways to profit with seller financing. Now, seller financing is one of the most profitable real estate strategies out there, and if you haven't checked out my full training series, click the link in the description. It's 100% free. With normal investing, investors save up some money and apply for either bank financing or hard money. The problem is that the bank will eventually cut you off because you'll be carrying too much debt. This may even hurt you when you're trying to refinance. This forces the investor to buy a limited number of properties and sell them to start this process over again. What makes seller financing so powerful is that you don't have to go to the bank for financing because we are getting the seller to finance it. And when you don't have to go to the bank for financing, you don't need a perfect credit score and beg for a loan, which also means that it doesn't go on your credit report. This allows investors to buy as many properties as possible. And when you purchase properties with seller financing, you own it. You have the deed. And this opens up many exit strategies. In this training, I'll be using an example where you seller finance it from the owner and then turn around and seller finance it to a new buyer. Now, before I dive in and show you how to maximize your profits with seller financing, be sure to click that subscribe button and like button for more future videos. So obviously, the first thing you need to do is find a property where the seller will seller finance it to you. One of the best ways is to send direct mail with REI Pro. We have custom built seller finance postcards and special reports you can use that explains to the owner exactly why they should consider this powerful way to sell their home. So let's take a look at this example. So here you need to set the terms between you and the seller, right? So the owner of the property. Now, keep in mind, we ran comps. We checked out the property in need of repairs. We've already done that analysis. I really want to break down how we actually profit with this business a little more in depth. Again, we do have a full training series that you can click in the description and check that out. So we set a sales price at $250. Now we know that it's worth more than this. And of course, we need to get a pretty good deal just to make the numbers work. We're going to put down $10,000 now. Again, that's a pretty good number, especially for a seller that, number one, is willing to accept payments and they're getting $10,000 down on the property. We're going to set an interest rate. Of course, we want to get this as low as possible. We set it at 3%. Now, you'll need a mortgage calculator to run these numbers as well as a deal analyzer to make sure that you're going to be profitable. So let me show you how to quickly do this in REI Pro. So here you can see I'm in REI Pro in our mortgage calculator. So my loan amount to the seller is $250. I'm going to put $10,000 down. My interest rate is going to be 3%. Now I am going to amortize this over 30 years to keep that payment down, but I'm going to set a balloon payment of 5 years. Okay, now you do have the opportunity to put in your taxes and insurance here. So if I go to yearly taxes, we're going to put $2,000 and insurance, we're going to put $1,000. We can then calculate this total payment. So our PI payment is just over $1,000, but our total payment will be $1,261. Now, if I scroll all the way down to 60 months, because that would be the last month I would need to cash the seller out, you can see at the bottom right here that my balance would be $213 after 60 months. Now, you also want to make sure you analyze this deal. And what I love about REI Pro is we have this awesome calculator where you could use multiple different strategies to analyze the deals to make sure that it's profitable. So here you can see that my seller financing strategy is to buy, but my seller finance strategy is also to sell. I'm going to set in all the basic numbers here to the left of how I'm acquiring the property from the owner, and then to the right, how I'm actually selling the property. And then it's going to start to give me all of my numbers calculated so I could quickly determine what kind of profit am I going to make from this particular deal. So highly encourage you, again, you want to do this prior to making the offer. Now that brings our monthly payment to just over $1,000. Now keep in mind, that's just principal and interest. Of course, we would need to add in the taxes and insurance, in this case, $250 per month. That gives us a total monthly payment of $1,261.85. Now the term here, we're going to amortize this loan over 30 years to keep that monthly payment down. But we're going to set a term of 5 years, meaning I'm going to make payments up to 5 years. Whatever my balance owed at the end of 5 years, that's what I need to cash you out, either by refinancing the property or technically I could just sell the property. Now keep in mind, we could buy day one from the owner, but we have up to 5 years, and this is what we call a balloon payment. Next, we're going to go market those buyers, right? So if you have a buyer's list that's looking for a seller finance opportunity where the buyer doesn't have to go to the bank today, maybe, they've need a little bit of time to get that credit back where they need to, or maybe they've had a job transfer recently and they just need a little bit of time. So this is a great way to sell a property, and it's extremely beneficial to all parties involved and one of the most profitable. So we find a buyer, we need to set the new terms for the buyer. So here we've bought the property from the seller via seller finance. We've closed on the property and now we own it. Now we're going to turn around and seller finance it out to a new buyer. Now, in this particular case, you could rent it. You could just sell it as is, maybe put a little money into it, rehab it. You could lease option the property. In this example, I want to show you how we seller finance it from the owner and then turn around and seller finance it to the new buyer. So if you're that investor that's looking for positive cash flow on a property you really don't have to maintain, because keep in mind that yes, we had the deed with the seller, but then we sold the property. Now the new buyer has the deed. So they're going to be responsible for all the maintenance costs, repairs, and all the things that come along with the property. You're just getting a check every month. So we set the sales price at $325. Keep in mind, we're going to run the ARV and comps and all that good stuff just to make sure that these numbers are correct. A down payment of $20,000, you will find you will get more money down when I give you the deed. If you were going to do a lease option, you wouldn't get quite as much money down because you're just leasing it with the option to buy. But with seller financing, you're going to actually own it. Now, in this example, we're going to get $20,000. Now, of course, we paid $10,000 to the seller. So anything over that 10, again, would be profit in your pocket. And if you could get 30, you could go 30 or more. Now we set an interest rate here. Keep in mind, they're financing it. They don't have the perfect credit to get that low, interest rate. So we're going to set it here at 5%. Now, sometimes I will play with this interest rate because the sales price and the interest rate totally dictate the monthly payment. And I want to make sure that that monthly payment's, going to make sense. Of course, the taxes and insurance, I'm going to just look at that as being a wash. That's going to give a total monthly payment of $1,887.31. Now we're going to set the term at 3 years. So we've amortized it over 30 years just to keep that monthly payment down, but they need to cash me out within 3. Keep in mind, I have 5 years with the owner. So you purchased and sold the property with seller financing. All right, so let's look at profit center number 1, which is the difference in down payment. So as you can see, we paid the seller $10,000 down and we received $20,000 from the new buyer. Profit center number 2 is going to be the difference in monthly payment, right? So forget about the taxes and insurance because to me that's going to be pretty much a wash, but let's look at that principal interest payment. So the new buyer is paying us $1,637 and we're paying the seller, let's say the previous owner, $1,011, and I'm just rounding it here just to simplify it. So as you can see, we're going to have monthly cash flow on this property. Now keep in mind, the new buyer's 100% responsible for all the maintenance costs and repairs. So the buyer sending me a check, I'm then sending a check to the seller, and I'm going to make the difference in monthly cash flow. The third profit center is the difference in sales price balance, right? So again, we need to use a mortgage calculator to actually figure out what our balance is going to be owed. So if the buyer goes all the way to the 3 years, I need to figure out what their balance is after 3 years. I also need to find the balance that I owe the seller after 3 years, because if the new buyer is going to cash me out, I have to cash the seller out. Even though I have 2 more years, it doesn't matter. Remember, I can buy it anytime within the 5 years, as well as the new buyer can buy it anytime within the 3 years. So after going through the mortgage calculator, the balance that we have with the seller is just over $224,000. With the new buyer still has a balance of $290,000. So that difference right there would be a profit center for you. So let's look at the total profits this far. Now, keep in mind, there's going to be 4 profit centers here, but I want you to understand the first 3 profit centers, and then I'm going to share with you something that's awesome, which I've used for years, and it's going to make you a little bit more money. All right, so profit center number 1 is the difference in down payment. So remember, we were paying the seller 10, but then the new buyer, when they bought it from us, gave us 20, which we have a profit here of $10,000. All right, so profit center number 2 is the difference in monthly payment. So here I'm just rounding the numbers. So we need to pay the seller, which was the original owner, just over $1,000, where the new buyer is paying us $1,637. $137. Now, the tax and insurance to me is just a wash, so I'm leaving that out of the example. That leaves us cash flow of $625 a month. Now, keep in mind, if they go the full 3 years, that's $22,500 in cash flow. Then we move to profit center number 3, which was the difference in sales price. So if the buyer went all the way to the 3rd year, they had that balance of 290, where we have that balance at 224. That's going to leave us a nice profit of 66,000. Now, keep in mind, yes, there will be closing costs when we buy it from the seller, and as well as when the new buyer buys it from us. I'm just leaving those additional costs out there. You're going to have some other costs, but this video is really geared to show you where those profits are. And of course, you would calculate in some of those expenses, which is going to reduce a little bit of this profit. So total profit, if you just looked at these 3 profit centers, almost $100,000. Now, keep in mind that was over a course of 3 years, but did you have any maintenance costs and repairs? No. Did you have any tenant headaches? No. You kind of get rid of all those things because the new buyer owns the property. They have the deed, which they are responsible for everything. Now, I want to show you profit center number 4, which is awesome. So I call this the sales price discount. So keep in mind, we owe the seller that 224, number. Now, my new buyer is getting ready to purchase the property, remember, at that end of that 3-year mark. Okay, so when the new buyer cashes me out, I have to cash the seller out all at the exact same time because they have a mortgage on it, right? I have a mortgage with the seller, and then the new buyer has a mortgage with me. So we have to cash everybody out. So when this day happens and your buyer is getting ready to close the deal, I want you to do this. I want you to ask the seller this question. I know I currently owe you about $224,000, but I just ran into a bunch of money. If I could pay you $210,000 today, would you accept that? Or do you want to wait another 2 years for your money? Now, a lot of people is, hey, just give me the money now, right? And if you did that, you could make more money. And in this case, if they accepted it, it'd be $14,500 just by simply asking for a discount. Now, you still have to close the deal no matter if the seller said, nope, I want my $224,000. It is what it is. So, but if you don't ask for a discount, guess what? You're never going to get one. And I couldn't tell you how many times I've asked this to the seller and they wanted the money now, because as soon as I say, hey, or would you rather wait another 2 years for your money, then I'll just take the money now and move on. So if you can make this happen, you're going to make a nice additional profit. So the previous total profit was $98,000. If you add that 14.5, you're just going to make that a little bit more. And that profit's also going to help with some of those additional closing costs and expenses that you may incur. Hey, thanks for watching, and be sure to smash that like button and subscribe. If you want to learn more about this powerful strategy, click the link in the description, and I'll see you on the next training.